Hi, it's Frank CappThesis. It's a pleasure to be with you here again on StockCharts TV. So today we're going to keep it very simple. We're going to be discussing just 4 symbols. And so question is, how can we spend so much time on just 4 of them? Now, I didn't say 4 charts, it's 4 symbols. And as we know, that one of the great benefits of StockCharts.com is the ability to apply many charts to various symbols. So if I go back and look at the S&P 500 over the nearly 2 decades that I've used the system, I probably have thousands of charts on that alone and hundreds on others. And what this is really helpful for is, from my perspective, is helps form a market stance or an opinion, but an opinion based on evidence, right? We have this mosaic we can choose from, numerous indicators. We can draw lines and annotate charts across various time frames as well. We really need all of that to give us a full picture of what's really going on under the surface, whether you're talking about a major index, crypto, individual stock. We know we can't just look at one thing and think that what that one chart is telling us is the full story. Now, we know we can't use every indicator, but over time, we know which ones are favorites and our go-tos, and being able to have a library with the new and improved sharp charts categories is extremely helpful. So if you haven't used this feature, I really recommend doing so, and as we go through all of these, you'll understand how powerful it is. So let's start with the S&P 500 and let's talk about some go-no-go trends as we have discussed here, I think every time so far since we've been doing videos for stock charts. And so the first thing is we look at this from a daily perspective, and we won't go into the particulars of this just yet, but I would urge you to look at the add-in features that are available on the platform, GoNoGo being one of them, which I found extremely helpful and a huge complement to much of the work we do at CappThesis. And so in general terms, as we can tell, the trend flipped to positive right here in the middle of May, right? And so as we know, this is a proprietary indicator, but as we can imagine, there are a number of moving averages, maybe some momentum type indicators in there showing that things were changing as the market was coming back. And that really lined up with some of the bullish patterns we were showing. And so needless to say, from that point, with the drawdowns being so minimal along the way, it has remained in a bullish tone, and so it's confirmed what we've been seeing with other charts, especially the bullish patterns that we rely upon all the time. Now, if you go to the page, you'll see there's 2 choices, right? There's the free version and also the premium. So in this particular chart is the free features. Now, if you go into the premium package, a few other things pop up on the chart like this, and we won't go through all of this, but what I want to talk about are these red arrows, and what these show is that there is a counter trend move within a market that is in go mode or in an uptrend or in bullish trend here. And so what it looks at is this oscillator, again, proprietary. One, it undercuts the overbought area, at least that's how I view it. It produces a red arrow. And as we can tell, there have been no red arrows at all going back all the way to late January, early February, the last 2 weeks, when we have 2 of them now in the last number of days. So at first glance, that seems like a bearish signal, especially knowing what happened after the last 3 occurred here, where this was in late October, early December, and then again in January, where there were pullbacks, not big ones, but noticeable pullbacks after each one of those happened up until the occurrence that happened in January. We had to wait a few more weeks, and as we know, the bottom fell out from the market after that. So that just doesn't give us a great feeling, knowing the S&P is up 30% from the lows and people are just waiting for one of these sell signals to work. Whether you're looking at this, a MACD sell signal, S&P 500 coming off an overbought condition at the mark, so forth and so on. None of them have worked so far. So seeing this particular one pop up again now just has us on notice, because the market has been pausing recently. And because it has been pausing, that has caused all of these indicators that we look at to come off their extremes. Just a matter of, will the next pullback, whenever it comes, be bought? And so I think it's very helpful to go back to another period of time as well, when really the pullbacks like this were non-existent. And that is from the beginning of the rally in late 2023. As we know, S&P 500 bottomed in late October and then went on this extremely consistent uptrending action. There are a lot of red arrows, meaning that the S&P went to, for lack of a better term, overbought, but had to come off of that just a bit, regroup, and then continue higher. And we're talking about not even having a pullback to late March here of more than 2.5% the whole way. And you can see this, again, if you look at the RSI, and what is the best case scenario for an RSI in an uptrend is just seeing the indicator oscillate between overbought territory and the 50 mark, and really 50 midpoint mark. And really, this is showing us the same thing. So this, I don't look at this as a sell signal. It tells us that the market is in a pause mode and needs to normalize some of these stretch indicators, again, no matter what we look at. And if it can, that is obviously going to be extremely enticing by the dip mentality. And this is really the first chance of seeing that from this perspective, which I have my eyes on very closely, especially as we get through July, which of course still has a ton of earnings to go and the Fed meeting at the end. And so from a weekly perspective, we've been waiting for this to happen, and it took much longer because the same indicators that this is using to develop a bullish trend just takes more time to work through because it's a longer term time frame, right? But now we're going on the 5th week of being in an uptrend, and we talked about this in the past, and you can look at it on our free CappThesis newsletter as well from Substack, is that if you look at prior periods going all the way back to the great financial crisis, a very similar thing happened where it had to take some time to come off of the lows and make sure that this market was going in the right direction. But once things started to really turn, that's when this triggered a bullish, go phase. And then, in the past at least, led to much higher prices in the weeks, months, and sometimes years to follow. And so we'll continue to track this as we go along and continue potentially to stay above the last high point from February. And so looking at the weekly moving averages, we look at the 13-week, 26, and 40-week. Again, 13-week represents 1/4 of action, 26-week, 2/4 or half a year, and the 40-week is just about like the 200-day moving average. And so what we have highlighted here in blue 3 different times is when that shorter term moving average here in 13-week overtook the 26-week, because that was an indication that things were changing both recently after the 2022 bear market and, of course, coming back from COVID. Because eventually, it's just a matter of time before all these moving averages start to curl higher, whether you're talking about a short term or a longer term like this. And if you are in the midst of having a long-term trend, then you'll continue to see it to the point where the best case scenario was what we saw here, 2020 and 21, and again for most of 2023 and 24, where the S&P 500 is higher. It's riding all of these moving averages with their shorter term ones higher than the longer term because it's closer to the price. And those moving averages then acting as support all along the way. And so, we had a huge historic 30% rally from here, but that's just now getting the moving averages to turn higher. And so we can maybe look 6 months out from here if things continue to work well, maybe not this explosive, but well, then it's not too much of a stretch to say that it could look just like this again, or just look like what was going on in 2020 and 21 after making new highs, after coming back from the volatility, is when we see, of course, the consistent, more calm, mature nature of an uptrend take hold. And that's going to be the next phase. Not going to happen right away. I'm sure there'll be pullbacks greater than what we've seen so far, but that is something we'll be looking for longer term going forward. So in terms of the patterns, this is the live ones we have right now. The S&P has already achieved 3 of our upside targets along the way. And so these currently are the large ones that still remain out there. And as we go forward, we'll continue to look for consolidation zones forming and, of course, being leveraged upon for smaller patterns. Because as we talked about in the past, for something like these to be achieved, 65.55 target, and then, of course, much higher, 67.45, we're going to need more of the smaller formations to form, showing that the market can catch its breath like it's trying to do now, take advantage of those consolidation zones and break out. So from the zone, we talked about this in the past, how we saw 11 consecutive bullish patterns play out from late 2023 to the end of 2024. That, of course, is a perfect blueprint to follow. I'm not sure it's going to work out that well, but that is something we'll need to see for these longer term patterns to eventually be achieved, especially if the one we've been watching eventually plays out like this. And we changed the look at this just a bit. Initially thought probably not too much of a stretch to believe that the S&P would have had a little bit more difficult time getting back above the February high that it struggled with so much. So far it hasn't, but the rally so far is getting a little bit slower. So again, with the potential volatility increasing at any point, wouldn't be surprised to see some back and forth action. And again, it may be around 6,200, maybe 6,100, who knows. But the point being is that anything that takes place around this zone and lines up somewhat with what happened toward the end of 2024 could be the right shoulder of something, right? And so we'll see how that plays out. But this continues to be a blueprint of which to follow. And again, if this were to be completed and then broken out, we're talking about the targets, in the mid 7,000s at that point, talking 7,400, 7,500. We'll see where the breakout actually comes from when it does. So turning to the SMH Semiconductors, obviously in the news, again, Tuesday morning after the good news, NVIDIA leverage, so leading once more. And so, coming into Tuesday morning, we had just seen SMH finally dip below this extremely steep uptrend line. And this is even a log scale. So it really tells you how substantial the move has been. And so we didn't know, number one, that this uptrend line, even if the semiconductors continue to lead, is eventually going to get, officially broken, right? And so the concern, of course, from that perspective is that something like this occurs after that uptrend line, which is both steeper and longer than the one that occurred from April through July, happened. And when that did occur, we know that things really unwound. And right around the same time of year, of course, it happened in July, mid-July, right around earnings season. We're right there once more. So there's a lot of similarities being applied to that period based on what's just happened over the last few months. And we know it's never apples to apples, but let's keep that in the back of our mind. So that's one thing we can all agree upon. That uptrend line is going to get broken. And just what happens after that is going to be obviously much more important. So let's go back again to 2020, because it's really the time where we can compare an explosive rally like this to. And, not surprising, off the lows, up a ton, as we know. But let's not forget, it wasn't straight up. And initially, we got that first break of the steep trend line at the end of April, early May. And let's remember, try to put ourselves back in that time frame where we're not too much removed from the low, and of course, not close to coming out of the COVID pandemic and everything attached to it. So there's still a lot of fear, both in the market and, of course, in the world in general. But what happened? We know that that didn't end anything at all. In fact, if we look all the way out from a year from that point, right? This is March. This is what was talked about going into the summer months of 2021. Look how many uptrend lines, number one, we can draw from the March 2020 low, and how many times the S&P broke them. Each one was eventually broken, even though the pace was slowing. Again, this is on log scale. So these are 8 different uptrend lines. Each one was broken. I can guarantee you, every time that one of those was undercut, there were calls that this market was rolling over, right? We can all remember that. So let's pull this out even further to the end of 2021, draw 2 more lines. Now we have 10 different uptrend lines, all being broken. The last one, of course, was the big one, and then the 2022 bear market occurred. And once more, we know that when that line was broken for the SMH and many others, it was clear at that point that things were starting to roll over. But again, it seemed just as clear when the other ones were being broken. So let's not get too crazy about the fact that we just have a very steep uptrend line being undercut and believing that that's going to mark the end of this rally. Right? There's enough evidence to show that things are different, and we're continuing to look at the bullish pattern and so forth and so on and judge things as they come along. But as we can tell along the way, what else we see? We didn't see any other patterns being broken, right? We didn't see any other bearish formations being leveraged upon until we saw that breakdown from there. And that was the big difference. So again, let's put this in context, right? This is the same zone as right here, right? That was the breakdown. Potentially, this was it. And of course, it looks almost laughable to believe this was a top back here based on what took place over the ensuing 2 years. And again, looking at this now, 2020 versus right now, looks similar to here as well. Just remember what happened after that first uptrend line break in 2020. A lot more upside to go until things broke down. And remember, that entire move from 2020 low to the high in late 2021 was over 230%, which started with a near 60% rally back to the highs, which the S&P or which SMH is right in line with now close to over 70% from that low and above those highs as well. And so looking at the SMH GoNoGo weekly trend, similar, right, to the S&P 500, finally changed from a bearish trend to a bullish trend as it was getting back to the highs from earlier this year. And then, of course, now still within a bullish trend, making new all-time highs. And again, that's very similar to what happened in 2020. It actually happened faster, where we saw the trend flip from bearish to bullish in the early stages, just in the spring to summer, and then really did not get affected at all until things changed in early 2022. Remember, as all of those uptrend lines were getting broken. And so let's move to crypto. And we're going to start with Ethereum this time because it's been doing better recently. And finally, we saw a pattern breakout that looks pretty substantial, right? It goes back to February. This is pretty clear from my perspective. Looks like an inverse head and shoulders pattern. And this is the first time since May that Ethereum has gotten to overbought as well. And as we know in the crypto world, being overbought can really lead to momentum getting even stronger. And so this target price would be above the area that it touched in earlier or in late December 2024, right around 4,000, which of course would then bring an even bigger target or an even bigger pattern into play here. This is going back to 2016. So not as many bullish patterns as we've seen in Bitcoin, but along the way, let's think about how much back and forth movement this is taking. Again, this is in log scale. And so this is 4 years in the making of back and forth price action percolating underneath these highs, eventually forming a higher low. And if we get back to 4,000 around there, right, where it failed that numerous times, you could be talking about a multi-year cup and handle pattern. Again, I think it's much more useful to view this one on log scale. And you can see that how clean that breakout was back in 2020 as well. And so, we'll see if that happens, but it's undeniable to understand what's going on underneath the surface here, right? Finally, a bullish pattern on a daily perspective is working. So far, we know how quickly they can get reversed, but if that ends up playing out, it would look like a major move back to 4,300 or so, which it would be, but it would just be getting back to a potential even bigger breakout zone if and when that happens in the ensuing weeks to months. And so what's also interesting about this is that finally seeing some outperformance versus Bitcoin. Anyone who follows the crypto market knows or has realized that at times when the crypto was really having one of its best runs, Ethereum would routinely outperform Bitcoin in some of the biggest bull markets. Remember 2017, Ethereum was doing much, much better than Bitcoin. Look, this relative line is nearly straight up right there. Same with 2019 and 2021. But since that point, it's been a slow grind lower. In fact, it got even worse in 2024. Ethereum couldn't really do much at all as, again, it was struggling to get back above to its highs as Bitcoin was continuing to make new highs. And now we can tell it's just been a few months, but since the lows here, Ethereum has been doing better. Now, we've seen bits and pieces like this before, and we'll see if this one works out better than it has in the past. And one indication of that, finally be seeing one of these oversold conditions on a relative basis, right? Ethereum versus Bitcoin, finally get it back to above that 50 zone, and we'll know if it's really working, of course, and finally gets back to overbought territory, which we haven't seen happen since the middle of 2021. So in terms of Bitcoin, along the way, we'll look at a few charts here. As Bitcoin was coming back here, it formed this right shoulder on a very short-term basis, broke out, and within just a few days hit the first target of 122.8. And as we know, things have been moving quickly, and Bitcoin's already off the highs by a good amount, but it got another target to be acquired. And so above that, and we've shown this one before, been waiting for this right shoulder to finally get or be completed and leveraged, and it did. And so it now finally that 142,000 objective is live. And so basically holding above the 110 zone is going to keep it there. So hopefully it does. And we know that how well that worked last time that occurred. So it looked very similar. This is why we kept on showing both of these patterns together. Now, let's not forget, we talked about this in terms of the S&P 500 as the market was trying to come out of the bottom from April, the need to see bullish patterns form and finally see an upside target hit. And when that first happens after a move lower over an extended amount of time, that can lead to more of the same. So the first time we saw that from a Bitcoin perspective was when we saw this breakout in late April, hit the 103 target, which then led to more of the same. In addition to that, along the way, what do we have? Failed bearish patterns, which was also a very key component to any uptrend. So we saw a failed bearish pattern here. This is a classic bear trap, which then turned into a potential double top. Also was a bear trap, and we see that bear trap ended up bouncing right near 38.2 retracement of this move. And again, bullish patterns working, bearish patterns failing. That's what leads to uptrends, and regardless of what asset class we are talking about. And so the next step here potentially is looking at this from this perspective. This is also a weekly chart. Instead of looking at this as classical patterns, these are, of course, continuation patterns. We can call them wedges, pennants, flags, whatever your favorite term is, but we can tell that these are just consolidation periods that are resolved to the upside. And each one of these so far along the way since the end of 2023 not only produced strong breakouts, but also were strong enough to get this 14-week RSI to extremely overbought levels, right? 80, 90 even. And so if there's one missing ingredient right now, it's that. Making new highs, of course, but not to the point where it's extremely strong when we saw momentum being chased in reckless abandon, really, a number of times in the past. So that will be the next stage of this. And maybe it has to form a bigger pattern to this point to really get to that 142,000 target. But again, understanding that this type of pattern has been repeated when Bitcoin really makes a move would be the next phase of this. And then another way of looking at this is going back to 2023 as well. This is now a log scale, seeing these breakouts just from those consolidation periods and how high or how much further Bitcoin had to go. 134% advance before the next consolidation phase, and then a 50% advance just from last fall to the end of the year. And so far, only about 13% above this last breakout zone. So from this perspective, it could have much further to go as well. And lastly, if we're talking about the biggest moves going back to 2015, there could be some major upside if this same pattern is replicated. And we've seen it replicated in the past, where these numbers are, of course, extremely big in terms of a percentage move after breaking out from multi-year patterns. So a 70% advance after the breakout from late 2024. It's pretty substantial, but not in Bitcoin terminology, especially based on what it has done in the past. So these are many of the charts we'll be looking at. And again, we did this all just in 4 symbols. And so we can see the process of taking the time to go through the StockCharts.com system, which allows you, of course, to annotate and to draw all these patterns, to apply all these different indicators, colors, whatever makes things more clearer to you, to come up with a thorough and complete analysis. Thanks, and I'll see you again next time.